Woo! Thank you, Steve. High five. There we go. Well, this is a very intimate group, to be honest, and hopefully it'll fill in after the next class. But you've got to be here for both 2 hours, so I hope you are buckled up and ready to go. And after the first 30 minutes, you're not going to want to leave anyway. I promise you it's going to be good. So now, Steve, do you have my clicker? Do I have a clicker? Clicker. Okay. So thanks so much for having faith that the tax and legal topic are going to pay off. If the beauty of this class is you don't have to go buy real estate or go do something to create savings or make money. In this class alone, in the next 2 hours, if I don't save you 10 grand in taxes, I screwed up. Seriously. So I want to throw down several little tips here. So I'm going to just give a couple of intros from this side, then we'll hit the whiteboard. So here's some books. Those are out on my table. I've got 3 or 4 books that are, Steve, if I just holler to you, will you hit down arrow while you're sitting there? Thank you. You'll be my clicker for now. Okay, so I'm done screwing around. No, I actually have some more fun pictures for a minute. So.
Try it. Okay, keep going.
Nope.
You just did it. You just did it.
Oh, okay, good. Okay. All right, so, I'm going to just do a quick intro because I want you to feel confident in what we're talking about today. So I'm a CPA and an attorney, partner in a law firm and an accounting firm. I've got probably 5, 6 books now out on Amazon. There's no other tax lawyer in the country specializing in small business and real estate that has as many books, as many podcast shows, and blog articles in the country. Probably in the next 2 months, I'll be on Fox and NBC in about 5 different locales, and hopefully out in New York again on MSNBC. I am trying to be an expert for you. So I just say all that because I'm going to get dorky and tell jokes and have fun, and you're going to go, this guy's a nut. He can't be real. So I really am, legit. But I want you to have fun in class too, because this is a dry topic, so we're going to screw around, have a good time, and I want to do as much Q&A as possible. So I'm going to hit, do I have my agenda first? Let's see. Okay, here's our agenda. The S-Corp strategy, how and why, very important in my top 5 tax strategies for 2019. I'm not kidding. Yesterday, I had a phone call with one of my clients when I was walking through the grocery store, told her what to do at Paychex to change their stupid payroll situation from their accountant that didn't know what they were doing. We literally created a $7,500 refund with one click of the button yesterday because she had her kids on payroll in the wrong way. Just literally $7,500. It was like $7,400 and change. It was a FICA refund. And it's very, very common that there's just something wrong. And you guys know this. You know this, but you just don't want to believe it. You want to think, my CPA, he's a really nice guy, or I do this on TurboTax and I freaking know what I'm doing. No, not every CPA is the same, and if you don't specialize in tax, you're going to miss something. And so you know how it is, you go do a kitchen remodel, you're going to get 5 different contractors that are going to give you 5 different results, right? Accountants are the same way. They're going to be lazy, they're going to be conservative, they're going to be anal, they're going to be in their little zone, they could be old. You're going to get 5 different results, if not more, by going to 5 different CPAs. You are the captain of your own ship. You should know the top 10 strategies you should be implementing, and if your accountant can't talk about them on the fly, you got the wrong accountant. You should not know more than your accountant. You've got to be on it. So today we're not going to talk about what form to put something. I want big picture strategies that you can quiz your accountant on, and if they can't respond or they look like a deer in headlights, you got the wrong person. So that's the goal here. You've got your first mate is your tax and legal person, and if they're not talking and working it, then you got the wrong group. So you don't have to use me, you don't have to use my firm, I do not care, but you probably need to upgrade, and we'll see today. There's always someone getting fired out in the hall after my class, and I'm always really sad. You suck, you're fired. So whatever. Okay, so we're going to hit real estate professional status, healthcare strategies for real estate professionals. Yes, there's a strategy you don't even know. You're going to freaking love it. And real estate and self-directing, which Matt Sorensen is teaching in another class right now, but we got to hit it together, and he'll be bouncing over to my class after his. Mine's 2 hours, his is 1, so he'll join us for the second hour. This is a very ambitious agenda. This is normally a 3-hour agenda. I got 2 hours. So we're going to blaze. I'll do a couple questions here and there. After each strategy, you need to be taking notes. Come on, where's your paper? Pencil? Is that your iPad? Okay, you're good? Okay, take notes. No screwing around. No texting. No watching YouTube during this. All right. Now, yes, this is recorded. I don't know how you get it, whatever Steve does on that. You probably get it because you paid for it, so. Okay, I will throw out a copy of my slides. I'll give Steve a PDF of it, and then he can attach it with the presentation. That's cool. And also, I've got 3 of my books here. This is The Business Owner's Guide to Financial Freedom, which you'll freaking love, The Tax and Legal Playbook, and What Your CPA Isn't Telling You. I've introduced these, oh man, they're so good. I'd want to talk about these more, but anyway, at the end of our class, in fact, at some point, I'll have you write your name and number and email on a piece of paper, or if you have a business card, we'll do a drawing. I'll give away these 3 books, and must be present to win. So if you leave in the second hour, you're lost. And you'll be on my newsletter. I have a free weekly newsletter I've been doing for 14 years with deadlines, strategies, tips, videos, and blogs every week. Open it up, scan it, close it. But do not just ignore it and put it in your spam. It's free. It'll be a very, very helpful resource for you. So by entering my drawing, you'll be on my newsletter. If you really hate me after, you can just unsubscribe next week, but I do not recommend it. For fun, I'm going to just tell you this one. This is the one book I love, and it's got 4.5 stars on Amazon because a lot of anal engineers like a really technical book when it comes to taxes, but I wrote this is my second book, and I wrote it to talk tax strategies. And I wrote like 13 strategies, 13 chapters, and I was so proud of it, and I was editing it, and I was working at Starbucks every night for like 2 hours, and And then I started to edit it, and I read through it, and I fell asleep reading my own book. I was like, what the freak, you know? And so I scrapped it, and I was watching Modern Family, right? Any fans? This was like 5 years ago. It had just come out. You know, we love Phil, America's Realtor, right? So, and I said, I've got to write a story where you'll actually want to read about taxes. And so I wrote a fictional story about good kids, bad kids, family, divorce. I wanted it to be a made-for-TV movie, so I worked in a sex scene. Sorry, BYUers, is that okay? Can I say that on stage? U of U rocks, BYU sucks. No, I can't say that. I bleed red, I'm sorry. We lost our bowl game, I know. It was a disaster. Okay. This is it. This is the first paragraph. Well, that's actually 2 paragraphs. It was a dreary day in March. You know the type of day. It was cold. The flowers had yet not started to bloom. One didn't know if it was about to rain, snow, or just stay cloudy and bleak. Sounds good, right? Okay. What made the day even more unbearable was that this day we went to see our accountant. It wasn't a meeting we looked forward to. Sometimes we talk over the phone or simply drop off our paperwork. Today, however, we were to meet. And that's it. You can't put it down. You just want to keep reading. You want to know what's going on. And I trick you. I trick you into learning about taxes. So it's a good story. It's one to get you juiced up. It's like a gateway drug to tax planning. You'll love it. So I'll give that away too. Okay, so a little bit more about me. Wife and 4 kids. I live up in Idaho. I know that sounds crazy. I'm dissing on Provo, but I live in Idaho, so I know, you know. But we were in Southern California, and I got sick of the traffic and the pop culture and the money. And I couldn't keep, and I just, and you can't be a self-respecting tax lawyer and live in California, can you? Can you pay 50% in taxes every year and say, I'm a tax planner? You can't. It is literally over 50% on your next dollar once you hit a certain AGI. It's terrible. So I said, screw it, and we moved to Idaho, where my wife's from, take care of some family, relax, enjoy the outdoors. I still travel a couple days a week. The business is still booming, a couple days a month, sorry. And, but I live up in Idaho. I grew up in Washington State. Go Seahawks. I was wishing they were in the Super Bowl this weekend, but oh well. Okay, sorry, Steve. You were looking to put some money down on the game. I've got this is a sure bet. I'm just going to tell you right now. Here it is. Okay, huh? This is why I'm your guy. Here it is. If you want a sure bet this weekend, there'll be, 2 minutes left. Rams will be up by 3 to 6 points. Tom Brady's going to get the ball on his 5-yard line. He's going to go down and score and win the game. There you go. That's it. If you know Tom Brady, that's all that's going to happen. Would you want to be up against him in the last 2 minutes? Just bet on the Pats by 3 or under, and you're going to win money. Trust me. Okay. So I'm from Washington State, and I do believe in Sasquatch. I have my own Sasquatch experience. So now we were doing our workshop in Seattle. Randy Lupke, my co-author of my book, the Business Owner's Guide to Financial Freedom. He was teaching a class next door. The hour before, he is my co-author, an awesome financial advisor, lives in California, do not know why, but he lives in Newport Beach, which is really pretty, and it's worth the money, I guess. Just joking, talk to Randy after. So we were doing our little hike in Washington. We were squatching, we were looking, if you've ever been squatching, you know, we were looking for Bigfoot, couldn't find him. Didn't know where he was. Okay, this is a laughing portion of the show. Was that not funny? I thought that was funny. And then we found him, and apparently he's a Mark Kohler fan. He was watching my videos in his camp. So I was really excited about that. And then we saw him in Seattle later, and he was carrying my book. So I was pretty stoked on that. Okay, anyway. All right, okay, let's get into it. Okay, strategy number one. Okay. The trifecta. If your accountant or lawyer does not get this, you're going to have to train them on it, and hopefully they come up to speed. But if not, this is the easiest way to do your tax and asset protection planning. There's three pieces to the equation. I want on the left side your operations. This is going to be your entity. If you're a realtor, you're getting commissions. If you're a flipper, wholesaler, if you're a dentist, a doctor, an engineer, you're a restaurant owner, import, exporter, internet marketer, MLM. That's the left side. It does not own assets. That's going to be ultimately an S corporation. When you're making more than 50 grand a year, I want to funnel it through an S corp. It could be an LLC taxed as an S corp. You have an S corp. Don't say, Mark, I have an LLC, and then 5 minutes later I find out it's taxed as an S corp. If you have an LLC taxed as an S corp, it's a freaking S corp. LLC on the right. LLCs are primarily for holding assets. Now, I might have 10 LLCs and 10 properties. I might have 10 properties and 1 LLC. Everybody's situation is different. We set up LLCs in the state where we have rental properties, and we design the LLC structure based on how much net worth you have and where your rentals are and all that good stuff. This is just a simple brother-sister structure. Now, I'll use LLCs in 2 other ways. Maybe we'll get into it. But this is your basic trifecta. S corps, LLC on the right, and then at the bottom is your revocable living trust. If you're an entrepreneur and you own a rental property, you will ultimately have these 3 structures. If not already, you better get on it, make it a goal for 2019. This is revocable living trust is your estate plan. That's your will, trust, powers of attorney, pull the plug if I'm a vegetable, blah, blah, blah. The trust is going to own your S corp, your LLC, and 3 other assets. It's going to be the beneficiary of your life insurance, investment accounts, and it's going to own your home. There's no tax with the trust. There's no public filing. You can modify it anytime you want. It's a revocable living trust, but if you die, you can just screw up your kids forever. It's awesome. They get money if they do this. They don't get money if they do that. If they're still married to that bozo, you cut them off. It's sweet. Money at age 25, 30, 35 in stages. They get a tattoo on drugs, cut them off, whatever. It's called dead hand control. Your hand comes out of the coffin and just screws around with your family because you hold the money. It's an irrevocable trust once you die. It's sweet. Provision of mine is if you go to U of U, you get all the money. If you go to BYU, it's cut off. It's just a standard provision. It just comes in your deal. I'm sorry. Boy, I know I'm being hard on my Utah Countyers, sorry. Okay, so this is the trifecta. I could talk about this for an hour. We can have multiple questions. Let me just set the table with what I want to focus on for a moment, and that is the S corp side of this equation. Let me get that on the table, and then we'll do 2 or 3 questions. So what we normally do, and this is your dial in your S corp strategy, if you are generating ordinary income, you need to know this strategy because there's a point where the S corp makes sense. There's a point where it doesn't. If you have a W-2 day job and buy rentals, you don't need an S corp. If you're retired and just have rentals, you don't need an S corp. But once you have an operational business of any sort, 1099 income, you'll pay self-employment tax on every dollar if you don't do some sort of strategy. Let me just give an example. So on our board here, if I've got a realtor here, or you're fix and flipping in real estate, whatever, if you do more than 3 fix and flips a year, it's subject to self-employment tax. Good luck in an audit if you think otherwise. So you got your money coming in. Let's say you bring in 100 grand. 100 grand net. You're cranking. That's on net sales on your fix and flips. You bring in 100 grand, you spend 25 on expenses, and you net 75 grand. Pretty straightforward. You're taking home 6 grand a month, whatever. You're going to pay self-employment tax off the top of 15.3%. That's 10 grand. Then you're going to pay your state tax and your federal tax. Bing, bing, bing. You get hit 3 times. So this is a sole proprietor or an LLC. But Mark, I thought LLCs save taxes. No, LLCs do not save taxes. No way, shape, or form. Why do we do LLCs? Protection. That's it. I want this warm blanket. I want this corporate veil. Sole proprietorships, we're only going to be in those for a short period and then out. But we're going to have our structure here, and once I start making over 50 grand, we're going to convert to the S Corp strategy. And with the S Corp strategy, instead of taking all of it net, we split it. Bink, bink. And I might take 25 grand in salary and 50 grand in dividend. Now I only pay the F word, FICA, FICA. I only pay FICA on 25. I just push the other 50 through the bottom, and I just save 15.3% on 50 grand. That's 7,500 bucks. Boom. And all I did was convert to an S Corp. Done. That, my friends, in my 25 strategies is number one. We've got to have our S Corp foundation nailed down. Okay, I threw out a bunch there real quick. Thoughts and comments, questions? Yes? Yes, it does, my friend. So his question was, does this get the 20% pass-through deduction? It does. So we drop another 10 grand off of this, and your net is only 40. So now that's the GOP Trump bill. When I had a chance to talk to a senator during the tax legislation last December, I was so excited about it. This is December 2017. And I was like, you got to save the S Corp. That was my sales pitch. We got to get the S Corp here. And freaking GOP and the Trump, they threw gas on this. The S Corp just got better because there's a synergy. I want to take the right amount of salary and push the rest out to get my 199A pass through. So that's another strategy in my list of 25. I got to make sure that I'm taking the right level of salary to keep the IRS happy and maximize this deduction. And you can swing 2 to 10 grand like that. Accountants will screw this up in a heartbeat, and you're like, oh, my brother-in-law, he's a really nice accountant, and we golf together. Did you talk about this? Did you push him? Did you have him explain why you're doing this? Did you compare it to what Mark Kohler said in his last newsletter or YouTube video? And then all of a sudden you realize, my brother-in-law is, way over here, and it's costing me thousands of dollars. You got to be the captain of your ship on this. You got to know why. Thoughts or comments? More? Oh, we got Randy. I know it can't be a question. Well, you will get one of two answers. So if you heard Randy, he said you go to your CPA and they kind of poo-poo the idea. That's option one. They go, nah, it's too risky, don't do it. Run, Forrest, run. Just run, Forrest, run. Fly like a bird. Just get out of there. You've got the wrong accountant if they're not even willing to talk about this. Number two, they may say, well, we're going to take a salary that's too high and your savings not good. So this, my friends, is why I created a matrix where I put my money where my mouth is. It's taking the country by storm. It is called the Kohler Payroll Matrix. So you know exactly what to take. Isn't this amazing? So exciting. Thank you. Okay, no, I'm just... Okay, let's see if I have a... Can you guys see this one? Or who can see? Which one's better with a stupid whiteboard? Here? Can you guys see over here? Barely? Can you see over here? We got this curtain thing going on. Okay, I'm going to try to do best here. Oh, I can't move the whiteboard. Oh, do this way? Okay, so you guys can see over here. I want to just show you. Okay, now here's the trick. You look at your net income, not what your S Corp made. What did you take out? Is a realtor, a dentist, a doctor, an engineer, whatever your business was, what did you net? And you might have multiple sources of income flowing into one S Corp. Mark Kohler, I only have one S Corp in my life. If Randy calls me up and wants to do a deal with me, my S Corp partners with him, not me. So my S Corp is my Microsoft. This is my parent. All my revenue goes into this, ordinary income. Then I take my net and I go across the bottom. And I go, okay, where's my net this year? Oh, I'm going to make 100 grand. So I go up and go, my salary better be in a $40,000 range. So if I net 100, I'm going to take 40 in salary, push the other 60 out. I just save 15% on 60 grand. For every 10 grand your accountant screws up, that costs you $1,500. A $20,000 swing is a cruise in the Caribbean. I mean, that's how fast your accountant can mess this up. So you want to find the right payroll allocation. I've interviewed ex-IRS agents on my radio show for years. We've never had an audit for any client of ours doing their payroll in the last 20 years. If we do your payroll report and you get audited, we'll pay the penalty. So when your accountant says this is too aggressive, you say, well, I'm going to freaking go over to Kohler then because he'll stand behind it. Now, let me repeat that. She goes, well, Mark, if I changed courses midstream, is the IRS going to notice this? You know how jacked up the IRS is, right? Like, they're not as smart as you think. And even their computer system, it just shows you had a different profit one year or whatever. What the IRS model, where we see the most audits or all the audits, is people taking too low of a salary, period. If you're in a range, the computer just, you just go, it's an algorithm. It's like, not a big shift, they're looking for the wrong amount. You can shift, people's businesses make different profit every year. Who cares? It's that ratio between shareholder compensation, line 13, and the K1. So I'll have a doctor come to my office, I'm coming your way. I have a doctor come in my office and goes, Mark, I made 300 grand last year and I took 10,000 in salary. Reap, reap, reap. It wasn't the shift, it was him being an idiot taking 10 grand. He's way off my matrix. So don't worry about changing it. It's where you're at in the ratio so the computer doesn't see you as a red flag. This is the extreme. They don't care if you take a big salary. That's in their benefit. Okay. No. She said, does the net number include your W-2? No, you do the net, you estimate your net before you do your W-2. Now you may say, well, Mark, I got to live during the year and all this sounds like a headache. No, this is so easy. However you're running your business now, where are my realtors in the house? I mean, okay, oh, love it. Okay, realtor. Are you an S Corp already? Yes. Okay. Now, I love this. Great example. Now we'll see how this goes. So you got your S Corp, you have a separate bank account for your S Corp. Your commissions go into the S Corp. Whenever you want to take money, do you have to wait for a paycheck or do you just take it?
I don't know enough.
That's okay. What do you do now? You just take your money, right? Yeah. So you have your S Corp, you have a bank account, your commissions go in there, you pay your cell phone bill, buy some lunch, fill up your car, and if you got money at the end of the day, the end of the week, the end of the month, you take it. Cool. It's called a draw. You just take a draw. And then, what do we do quarterly? Every 3 months, someone calls you, right, and says, it's time to do... Okay, she's not in charge of this part. Every 3 months, you have to go do your payroll. So it's going to happen in April, July, October, and the end of the year. And my accountant's going to call her up and go, hey, how'd you do? She's going to, oh, I took home $30K this month. I mean, this last 3 months, I took home $30K. I had 4 closings. I was killing it. Okay, sweet, you took home $30K. So we look at the net. How much did you take out in profit after your expenses? And you can ballpark it. Throughout the year, it's going to fluctuate. I'll call you up in April, and you go, yeah, I took home about $30K after expenses. Okay, sweet. We go to the matrix. Okay, if I do 30K times 4, that's 120. Okay, let's do a payroll of 46. Let's do the math. That means payroll of 12 grand. Okay, here's your payroll report. We do a payroll report of 12 grand. Send her a 941. She sends in a deposit for around $1,700. FICA's paid. Done. It's done. If she waits till the end of the year in a sole proprietorship or LLC, she pays FICA on the entire 30 grand. All you're doing is just changing the allocation of what that 30 grand is. We're going to do 10 grand in payroll, 20K in pass-through, get the 20% pass-through deduction. We're off to the races. You feel it? You feel it? Isn't this exciting? Okay. Okay, and let me see if I answered that fully. Yes. So it's easy. You just do it. You don't ever get a paycheck. Do you ever get a paycheck? No. Call the police. Okay. No, she doesn't get a paycheck. She just does a payroll report quarterly. Now, you, after this class, you want to be a little more engaged in this. You want to say, what's my payroll this year? How much am I going to make? And all of a sudden you find out, what the freak? My accountant's jacking this up because I'm a salesman. I'm going to go out and be a realtor. I'm really good at sales, and I'll just let that take care of it. No, this is the yin and the yang of being a business owner. You may be able to make money, but you got to guard the hen house. You don't want the IRS getting in there and being the number one cost in your life and taking too much. So just know enough to manage your professionals and say, I want to know what my freaking payroll is. Yes? If you do this once a year, let's just think about it. Does the IRS want their check at the end of the year, or would they like it 4 times during the year? If you don't do it quarterly and you wait till the end of the year, unless you have a seasonal business where you make all your money in December, the IRS is going to penalize you. And so I tell my clients, you want to wait till the end of the year, that's cool. But when you get the penalty, I don't guarantee that because you screwed up and you waited till the end of the year. Plus you got to do 940s the first, second, third quarter and then just pound it in on the fourth, which is cool. And you might get away with it for a year or two and go, Mark, that's all I've been doing. Just be aware, you get that nasty gram from the IRS. Yes?
Are there ever reasons why you wouldn't have two S corps?
The only time I have two S corps generally is if I have a husband and wife. One's a realtor, one's a mortgage officer, one's a dentist, one's a doctor, one's a financial advisor, one's a surgeon, because they have different professional licensing requirements where they can't have non-professional licensed shareholders of the same entity. But 98% of the time, husband, wife, one S corp. And we're on strategy one. I'm going to talk about when do you put your spouse on payroll? When do you put your kids on payroll? We're just talking about you. I mean, we're talking about thousands of savings on step one. Isn't this exciting? Come on, give me, come on. Yes, come on. This is great. You're saving money? Okay, yes. Mm-hmm. Yeah. So what he's saying is, well, Mark, if I'm in this and you sign it and you're cool with it, should I worry about being audited? No, because you're okay. What I want you to do is I want to guide you through the areas where you might get audited and lose. You know, like if you're doing payroll once a year, you would lose. And so I don't want you to do that. And so I'm going to warn you on those things. Ooh, where did Randy go? The one time I had a good question for him. Randy Lubke, you're wanted in the office. Randy Lubke. Okay, if you see him, tell him to run back in here. Did you see him? There he is. You know, soon as you leave to go get a bottle of water, someone asks a question, I need your help. Run up here fast. Okay, so the question, this is a classic. I did a whole radio show on this topic. And I had a phone call this week from a client that goes, it was Jim Banniger. He's a radio show host out of Chicago. I was on his show 2 days ago on the AM commute, and he was saying, I take a huge salary because I want to contribute and get the most as I can out of my Social Security. Randy, what would you say about that? Should I pound as much money as I can into the Social Security? Because I'm sure if I put more money in Social Security, I'm going to get more out?
Yeah. How old is he?
This guy was 70.
This guy says he was
But
70.
this young guy is over here saying, should I pay more in Social Security?
Is your Social Security benefit based off of the salary or your draw?
Your salary.
Salary only, W-2 only, yeah.
But that doesn't mean you jack it up either.
Yeah, because, you know, get to remember a couple things about Social Security. First thing, it's not a savings account, it's an insurance policy, right?
Hear him out, hear him out.
Yeah.
Well, yeah, is it going to be there or not? We're not even talking about that. Hang tight. This is good.
Yeah. So it's all about the W-2, right? And Mark's point, and I think it's a really good one. You know, you can shift this money down to your K-1. You can take that money then and put it into a 401k or an IRA, self-directed, do all kinds of things that you control. The money that goes into Social Security going to the federal government. And, you know, it should be there. It may be there. We don't know for sure. So certainly some of it's going to go there because it has to. Some of it should go there because maybe you want to. But you don't have to give them the whole $140,000. And especially this for spouses, if you have you and a spouse in the same business, that's $280,000 getting taxed at 15.3%. Yeah, why would you do that, right? If you've been married to somebody for 10 years, you're guaranteed to get a spousal benefit no matter what. Yeah, that's equal to the higher of the two of you, right? So whoever's paid in more, that's already guaranteed. So once you've gotten past that 10-year window, then that spousal person shouldn't even be paying into Social Security at all.
I'm going to say it one other way. It's called a law of diminishing returns. I wish I had a good example. Like, you can only work out so much. Oh, here's a good example. You can go to the gym every day and work out, but at some point, your body's going to do what it's going to do, right? If you work out an extra 2 hours every day, you're not going to make much of a dent, you know? You're just not. Look at Randy. I mean, he works out 3 hours a day. He could do this in an hour. Really? Okay, but... right? There's a law of diminishing returns. Yeah. Now, there's a law of diminishing returns. It's the same thing with Social Security. You take off. Okay. Thanks, Randy. So with Social Security, the more you pay in doesn't mean you get more in Social Security. Social Security is going to tap out at about $2,400 for a typical person wage earner during their life, no matter what your salary was in the long run, because it's based over your career earnings. So me and Warren Buffett, we're getting the same Social Security. So once you pay in your minimum level under IRS requirements for an S Corp based on your income, you're going to get the same Social Security as someone that's doubling down. So don't get confused and think that, oh, well, I'm screwing myself with Social Security down the road. Freak, I'd rather have you put more in your 401k than I would Social Security anyway, right? Just do the bare minimum, get in, and get the freak out. Okay, last question, then we're going to move on to a new topic. Anybody? Whew, okay, this is good. Isn't this fun? Okay, all right. So that's strategy number one. I want to give you just a couple other updates. So under the new Tax Cuts and Jobs Act, remember, entertainment is no longer a deduction. That was one of the ones, we took it in the shorts on this. Most of you know that in 2018. You can't write off the spa, the golf, the theater tickets, the sporting events. We can still write off the dining. So if I go to Top Golf and do some entertainment with one of my clients, I can write off the dining, but I can't write off the Top Golf.
So I take my staff, I have 15 people, I take them for spas and you're saying I can't write off that, so just take them out to eat?
Okay, I'm going to move on. I do not want to give her some bad news. So here,
Mine or theirs as well?
both.
Oh, that sucks.
I know. This is, hey, you got me on camera? Thanks. What's up? Okay. They are recording this. You don't want to get your arms tired. Okay, that's cool. You can do it. Let me stand like this. Okay. So anyway, yeah, sorry. Now, let me say this for everybody. This is why I want you getting my newsletter every week. Because as soon as there's a new tax reg, do you know there was 5 regulations that came out after the Tax Cuts and Jobs Act? Each one rocked my world. I'm putting those in my newsletter for you. One of the big ones that you would have gotten alerted to is in 2018 and until 2023. So it started last year, and it's now this year too. And I'm glad I brought it up. I thought I wouldn't do this because anyway. So entertainment is gone. No longer a write-off until 2023 when that, because all these tax cuts and the 20% is temporary. It's temporary until 2023, and then Congress has to revisit this. That's how they punted it to the next Congress. So no entertainment. That's spa, the golf, whatever. So people are having to reevaluate this. I did a TV spot in LA where the entertainment industry is freaking out. This is affecting golf memberships. It's affecting skyboxes at all the baseball games, the football games, because those skyboxes are no longer a write-off for the corporations. And the theater tickets, the company buys 4 or 6 seats at the theater and gives them to their employees, can't write that off anymore. So be careful with that. Now, dining is okay. Do you know, there's a golf course down in Alabama, and this was a cool strategy. You know how you pay annual fees to golf, the golf membership? Well, that's no longer a write-off. So what they did is they said, you can eat at the club as much as you want, and the golf is free. And they changed the golf. This is serious, the impact this law is having. Golf memberships are now being changed to all that you can eat, and the golf is free. Is that smart? I was like, oh my gosh, I freaking love that. So anyway, so now team building events for employees are okay, but there has to be interaction. A workshop, a lecture, a spa isn't going to cut it. A football game, a baseball game, or Top Golf. So you can. So be careful with that. I have YouTube videos on this and articles and videos in my website, and I've got a little flyer where you can get more info. Okay, let's move on. Okay, number 2 strategy. Now this is just easy stuff. I'm just going to hit a couple easy ones, and then we'll come to more hard ones. But this is one that affects everybody in the room. Everybody in the room is going to save money on this. Some of you are like, Mark, I don't need an S Corp. That's cool. Auto versus travel. Travel is 100% write-off. Travel is airfare, hotel, rental cars, trains, subways, valet, Uber, taxis. That's all 100%. As long as the trip is good with a business purpose, you're going to write it off. So I want you to have a business purpose of the trip, and if you're there multiple days, you have to have a good reason why you're there for multiple days, or 4 hours or more qualifies as a work day. So if you're going to go travel somewhere and go work on one of your rental properties, you want to be there 4 hours a day, and then it's considered a business trip. And the days of travel are considered business as well. Question on this? Yes. So if you take your business partner, someone on your board of directors, your board of advisors, when your kid is on your board of advisors, a topic I'm not even getting in today, any of you that have kids over age 15, they should be on your board of directors, board of advisors, and you travel with them or their business. My daughter's working my book table out there. She's a complete tax write-off for all of her school tuition. She's going to BYU. I know, and I have to write a check to freaking BYU, but I don't. I give her a 1099, and then she pays her tuition. I get 100% write-off. See what I'm saying? Okay, so anyway, any travel with another person that's business related and you're flipping the bill for them, that's a write-off. So that's travel. Now let me give you an example on travel days, which I love about this. So let's say you travel on Thursday. You're going to do business on Friday, today. So you flew in yesterday. Darren Munson, one of my clients, is here. He flew in from Minneapolis. Yesterday he flew in. That's a business day. Today's business, because we were here doing our workshop. Some of you will be here tomorrow for business. Oh, but you got stuck here on Sunday. Maybe you go on a hike, maybe you just enjoy the area, and you do business on Monday because you had to meet a client or go somewhere, do some business. Then I travel back on Tuesday, 100% write off the whole 6 days. Because if you get stuck somewhere on a weekend, as long as you bookend it with business on Friday and Monday, the whole trip's a write-off. That includes your hotel, the food, 50% on the food, but 100% on all the other travel. So all of you, here's why this is such a great little strategy. So many people, I look at their tax returns, and travel is like a small item. I'm like, do you go anywhere? Do you ever go to Vegas? Did you have your board of directors meeting this year? I just have one sheet of paper from LegalZoom. Okay, that's part of the problem. We'll get back to that. But we need to have a real functioning company where you're doing meetings everywhere you go for travel. Oh my gosh, I have so many examples, but we'll move on. Now, auto, this is the one that's sweet. Oh my gosh. Guys, you're going to love this. Any questions on travel real quick? I'm sorry, I'm talking so fast because I want to get so much out to you in just 2 hours. Okay, she's going to Jacksonville, Florida to look at another property. She said, no, she's not going to Jacksonville property to look at another property. She's going to Jacksonville, Florida to check on her rental. She's going to go to Jacksonville. She has a rental down there. She's going to go meet with the property manager, go say hi to the tenant, go meet the pest control company, kind of check on things. Oh, and while you're there, you're going to go look at another property. 100% write-off. Done. See what I'm saying? Now, also, you cannot write off a trip to go shopping for property. You're like, Mark, we went to Hawaii and we looked at a bunch of rentals. Okay. Shopping trips are not a write-off. You have to be checking on something you already own or making an offer. Then I can write off the trip. And if you're 10 days in Bahamas, I might write off 100% of the airfare, but I'm not going to write off every day you're there for your board of directors meeting. You get 1 day. So this is why workshops, meeting with clients, meeting with customers, checking on real estate, making offers. My wife says, Mark, just show me you love me and take me on a trip that's not a tax write-off. No, I can't do it. Our 20th anniversary, she goes, I have to sell books in a lobby on our 20th anniversary? I go, honey, they're paying for the montage. Come on. Okay, it's the montage. So, okay, yes.
So you have meet a vet.
But never made it buy. I would not write that off. He said, well, they got to be legit offers. He said he went to another state, looked at some properties, interviewed some property managers, but never made an offer. Can I write off my trip to Arkansas?
What if you made the offer after you got back?
Well, if you made a legit offer after on one of the things you looked at, okay, where I'm in the money, but it's got to be legit. And if you're in the regular practice of making offers like this, I'm going to be cool too. But if you're buying your first rental and you went to go see grandma in, Kentucky and then you never bought anything, I can't write off that. Now, on the last note on this too, our board of directors is my family. On my own S Corp, even though I have a law firm, accounting firm, and other board members are there, but on my S Corp, it's my family, it's the board. So it seemed like when we were living in California, every November, I'd load up the employees, the kids, we'd fly to Salt Lake City, get our rental car, the minivan, and we'd drive to Idaho to go check on the duplex that I bought right next to my mother-in-law. We'd work on the duplex. We'd have turkey dinner on a Thursday, I don't know why. Then I'd load up all the employees, get back in the rental car, drive back to Salt Lake, and fly out, 100% write-off. Everything, because I was going to check on my rental. I literally bought a duplex next to my mother-in-law. Buy rentals where you freaking go. Okay. Oh, yeah. Yeah. She's saying I'm making offers, I have legal costs, this, that, and another. You're going to take a write-off for those, and yada, yada. Now, due to time, if people funnel in from the last class, come on in, join us. I'm not going to take a break. We got to blaze through. We're already behind schedule. Okay, now, auto, guys, this is going to blow your mind. I'm not even kidding. In Chinese culture, this year is the year of the what? Anybody know? Year of the pig. Okay, in the United States, it is the year of the auto. The Tax Cuts and Jobs Act is freaking off the chart. So even though you can't write off your spa, pay attention, look at me. Okay, even though you can't write off the spa, I'm just joking. She's like taking notes on her phone. I believe you. Whatever. But I would say, even though you can't write off entertainment, the auto got better. Why do you think they made the auto deduction better? What was Congress trying to do? Encourage auto sales, stimulate the economy, make money for us with our GNP. So here's the deal. I want to show you this. There's two ways to do your auto, and all of you have an auto deduction, and I can guarantee half of you, your accountant's scared of their own shadow and not maximizing it. You got to look into this. Make sure you're following this one. So the two items. Number one, you can do mileage. So you can do 58 cents a mile this year. The highest mileage deduction ever per mile, 58 cents. Just to have fun with this. Oh, my phone's outside. Who's got some, could you pull up your calculator on your phone? Who's driving a Prius that'll admit it? Anybody? Just throw it out. Anybody driving a Prius? Okay, I know. I'm sorry. I know, I hear you. It's okay. I used to drive a Leaf, but I was sick of getting beat up at truck stops. Okay, you got a calculator. So let's say, what do you get on your Prius? Hold it. She walked out. What do you get on, what do you think, 40 miles per gallon? Okay, so let's do 40 times 0.58. $23.20. So for every time I fill up a gallon of gas in my Prius, I get a $23 write-off. Even though the gallon of gas, what, $2.50? $2.75? That's the power of a car with good gas mileage. Don't even bring up electric. So now I've got the mileage deduction is off the chart. You literally get a $23.20 deduction for every gallon of gas you throw in your Prius. So that's mileage. We got medical, moving, charitable, we could go there. But the other option is actual. Now I'll tell you, for the entire practice of my career, the last 20 years, if anybody had a car, 99.9% of the time, we would go mileage. Because car actual sucked. Because there was all these depreciation limits from 1970. In fact, let me give you an example. In 2017, a luxury vehicle was anything over $15,800. I mean, it was like crazy. This is like really 1970. Anything over $15,800 was a luxury car. So if I bought a 2017, a $40,000 car and drove at 100% for business, do you know my maximum depreciation for the first 5 years, total for 5 years, would be $15,060. It would take me 19 years to depreciate that car. This is 2017. That was the rule. So this is why your accountant had you doing mileage. So be it. Under the new so-called luxury automobile limit, it's now $50,000, and there's a bonus depreciation of $8,000 if you go out and buy new or used, which has never been allowed before. You always had to buy new. So I can go buy new or used, get an auto, and I can write off the first $8,000, and the luxury limit's up. And what that means is if I bought a $58,000 car, my depreciation in the first 3 years would be $43,000. I could write off 75% of that car in the first 3 years, plus fuel, repairs, maintenance, and insurance and interest. I'd have to do $75,000 in miles to just get a $40,000 write-off. I'd have to put 100,000 miles on that car to get the same of actual. Now, we knew this was sweet for SUVs and trucks, right? But the auto is now freaking off the chart. And this is awesome. So if you're in the market this year, you cannot change to actual unless you buy a new or used car. Hence, we are stimulating the economy. Go out and buy something new or used. But that's beautiful because you can go get the pre-owned Beamer with a 20% off the sticker price and not have to pay, the brand new car. Even though you like the new smell, don't do it. Be conservative, be careful. This is crazy. But it only gets better. It's sham wow. Okay, now let me throw this out first. It gets better with SUVs and trucks and big trucks and RVs. The bonus depreciation is unlimited. This was a loophole in the Tax Cuts and Jobs Act. No one even got this until like March. The first 3 months, I didn't even see this. This is crazy. Do you remember the old rule with an SUV? You could only do 25 grand, and then you had to depreciate the rest. Now I can go out and buy a new SUV or used this year and 100% write-off. What? Is that nuts? Okay, question? Or was it on the SUV and truck?
Still trying to put this together and trying to remember what I
Yeah. Has he been bucking for a new truck? Oh, no. Now we've got marriage counseling fees. Yeah. Those could be deductible as, yeah, marriage counseling is deductible in our medical expense, so we can do that too.
My question was, could I go out, buy a $50,000 truck, hypothetically?
Hypothetically.
And put $1,000 down, finance it, still get all the write-offs?
We can cover her ears. Don't let her hear this. Okay, so what he said was, I could put 1,000 down, finance the whole rest of the freaking truck, 50 grand, used, and write off the whole thing this year, $50,000 write-off.
You're literally making money.
Huge. Now, that's assuming it's 100% business use, which means you better have another vehicle for personal use, commuting and personal. I tend to go with most of my clients at 90% business use, because I know you're going to go to the mountains, you're going to go to the lake, you're going to go to the grocery store, you're going to go out to the movies. So it's really hard for me to look at the IRS in the face and go, oh yeah, they're 100% business use. Nah. Unless it's a delivery truck. Okay, we're only on strategy 2, 3, okay, we're on 4. Okay, anything else on auto real quick? All of you should be finding your strategy and dialing it in for the year on auto. Okay, family on payroll. How many of you have kids under age 18? Anybody? Okay, at least half. I'd say half the room. How many have kids over age 18 but act like they're under age 18? Okay, that's good. There we go. Any grandparents out there? Oh, okay, this is good. So, here's my concept. Hang with me. Quit paying taxes like millions of Americans and giving your kids money. Quit paying taxes and paying for your kids' soccer, school lunch, school clothes. Quit paying taxes and paying for your kids' tuition with your money. Put your kids on your payroll and take a tax write-off and let them pay in their own bracket. That's it. That's it. You don't have to be rich to do this. Just change the way you're already doing it. If you're spending a couple grand a year on maintaining that little soccer kid, baseball kid, school clothes, school lunch, which you know you are, quit paying for it. All my kids at age 7 had their own debit card. Mom would hold them in their purse. I have a 15-year-old now. In fact, Molly, my 15-year-old last week, Dad, I'm going roller skating. She got some new roller skates for Christmas, kind of roller skating thing right now, whatever. So she's like, we're going roller skating. I need $20. I'm like, did you come by the office and do your paper shredding? You do your thing? Yeah, I came by. I'm good. I'll do it. I'm kind of, okay, cool. So she came by. I didn't give her $20. The company transferred $20 into our family management and down to her, and we took a $20 tax write-off for her to go roller skating. So I took the tax write-off for that. See, I'm paying my kids for working in my business. They should be on the board. They should be having duties, and I'm just paying them. And now I'm taking a tax write-off and letting them pay in their own bracket. So that's the concept. Okay, now how do we do this? Oh, by the way, you're going to save taxes. You're going to hopefully teach them to be a little more self-reliant. You're going to teach them small business skills. All my kids have their own small business. Save money in the business without having to hire outside help, and teach them how to do a hard day's work. This is what we're trying to do, hopefully. Okay, so, here's a picture of Molly. This is her. She got Employee of the Month. We're excited. I've kept that little piece of paper in our memory. This is her at the bank when we opened her bank account, because all the kids have bank accounts at Wells Fargo. She fell asleep on the job here. Almost got fired for that, you know. This is my teenager getting paid. They're not as grateful. But notice what she's doing on her computer. That's QuickBooks. All my kids know how to do QuickBooks too. So we're doing QuickBooks and all that. So powerful. Now here's how we do it under age 18. We never pay our kids out of an S corp. So for those of you that have the S corp thing going, what we want to do is set up a little sole proprietorship. So you could have an LLC, or you could have an S corp, or an S corp. LLC taxes an S corp. Okay, and then over on this side, you've got your rental properties, right? And there's your rentals, and everything's cool. For your kids under age 18, you never pay them out of your S corp, because then you have to withhold pseudo-futa, FICA, and workers' comp. So what we do is we set up a little sole proprietorship, or you can pay them out of your real estate business. You could pay them out of here, but we pay our kids under age 18 out of a little sole proprietorship. So I transfer money from my S corp, then I transfer money to Molly. Done. I just got a tax write-off. And if I can push, how much can I do, right? I start putting kids on payroll when they're about 6 years old. Then they can polish shell casings with their fingers. They can, work the paper shredder. Their cans always get stuck in the paper shredder, but it's okay. They grow back. But These are jokes. Can you guys get into this? Are you not having fun? I'm trying to throw out my best jokes here. You're killing me. Anyway, so what I want is the kids having little jobs in the business, and you might pay a 6 or 7-year-old $100 a month to clean the office, shred paper. A grandchild could be helping you out. Anybody that young. But then when they turn 9, 10, 11, 12, they're teenagers. This year, this is where the Trump GOP bill got better. You can pay your kids up to 12 grand. You get a complete tax write-off, and they don't even have to pay taxes. They don't even file a tax return. That's their standard deduction. You do not 1099 them. You do not W-2 them. It's just called outside labor. So there's no W-2. There's no 1099. And I could pay them up to 12 grand. This is where just yesterday, I told you at the beginning, I had that phone call with the client, and we moved their payroll from their S Corp to their sole prop in one fell swoop, and we saved $7,500 in FICA tax. Anyway, so huge, yes.
At what age does the IRS justify that being a reasonable wage?
Okay, so you need to come up with a reasonable wage for your child, no matter what age there are. We're going to try to help you as your accountant. If we see it off the chart, we're going to warn you. But you know, it's cool to see a 6 or 7-year-old getting paid $1,000 a year, and then teenagers, it can range from 5 to 12 grand, somewhere in there, depending on if they're working in the summers, working to after school and all that, and they don't even file a tax return and you get a write-off. It doesn't matter. All of you, let's back up. She said, what age do kids file tax returns? In the United States right now, all of you in the room, if you don't make more than $12,000, are you required to file? No, that's your standard deduction. It's not an age thing, it's your earned income. So none of you in this room, if you make less than 12 grand, which I hope doesn't happen, but if you make less than 12 grand, you're not even required to file. And that includes your kids. Okay, now here's a couple options. Now I said you don't have to. You might want to. Now that my kids have some earned income, I don't know, what could I do with that? If I filed a tax return, my kids could open a Roth IRA. So now I pay Molly 4 grand. I actually paid her 5 grand this year. 5 grand. I paid her 5 grand. I got a $5,000 tax write-off, which I didn't have before. I can take her 5 grand, put it into a Roth IRA, and her Roth IRA can invest in my next LLC to buy rentals, and all the money that comes out tax-free. I can pull out all the contributions tax-free for college, and I'm building a Roth IRA for a 12-year-old. Now, I want to file a tax return if I'm going to start funding Roth IRAs. Also, my oldest son, now that's 23, he went in, this year he has a fix and flip in his first home purchased, and he's 23. I'm so excited. He went in and got his own credit and his own loans and did the whole thing on his own with some coaching, but on his own credit because we've been filing tax returns for the last 4 years. So when you start filing tax returns for your kids and getting some credit cards and putting them in the drawer, you're not only building a tax deduction, you're also building credit for them in the future. There's so many ancillary benefits here. My Sydney that's out there at the table, she's been on my payroll, 1099s, because she's over age 18, for years. Last 2 years, she's filed tax returns. Now she gets Obamacare health care for $20 a month. I dropped her from mine. But Mark, you can keep your kids on your health care till they're 26. Why, when she can go out and get her own plan for $20? And she can do it because she has a tax return. So there is a point where you might want to file a tax return, but you don't have to if you don't want to. Deep. Isn't this sweet? Yes. Well, he said the earliest age you can pay your kids. I've got a client that pays his kid 10 grand a year and she's 2 years old. He's in Maui, he's an artist. She is literally in paintings that are sold for thousands of dollars. I've got a pediatrician that has his 3 and 4 year olds and he pays them 3 or 5 grand. And they're pictures on all of his social media, on his brochures, and on the walls of his pediatrician doctor's office. So if you can find a reason why it's legit, now if you're going to use the modeling strategy for your kids, don't show me your kid. I mean, I'm sure they're adorable. I've seen some of my clients' kids. I'm like, don't bring them to the audit. I don't think it's going to fly. Yeah, that's rude, I know. But okay, anyway. Okay. Now, a grandparent would never say that about their grandchild, but okay. Now, if they're over age 18, let me just say this. Once they're 18 or over, then we 1099 them. I just 1099 my kids. Done. So if they ever need money, I never give them money. They always get a distribution from the S corporation. Yesterday was January 31st. Any of you processed your 1099s? Yes, you did. I processed my 3 kids too. Ding, ding, ding. I usually hold it until the end of the year because I love at Christmas time to put their 1099 in their Christmas stocking. They love it. It's really nice. They come out, they want to play, and I'm like, hey, go play with that 1099. It's a really neat thing. Okay, now that's the older kids. Now, grandkids, oh yes, go ahead before I do grandkids. Yes, now she made a great point. And I have 30, 45-minute videos on each one of these topics today. I've actually got 60 videos and 32 hours of content that you can watch with a bowl of popcorn and Diet Coke. I'm just trying to hit the highlights in 2 hours, so I'll tell you how to get that if you want it. But she said, hold it, Mark, I don't have an S-Corp, but I got a bunch of rental property in an LLC. Sure, your kids should be helping with property management. 1099 them. Done. So you can pay them out of here, you can pay them out of here, or you can pay them out of here. It's the ones that are under age 18 that I have to funnel through this. Yes?
So my son's over 18,
Okay.
paid my S-Corp. My CPA told me that he has to pay self-employment tax.
Yes. Okay, good comment. So once you pay your kids over, she said S-Corp. It's S-Corp. I know some of you guys want to call them an escort. That's our Vegas strategy. But this is the Utah strategy. S-Corp as in P as in Paul. Okay. So S-Corp. When you give him a 1099, he's going to be subject to self-employment tax. But now what does my son have? When I give him a 1099, what does he have? What's our number one tax strategy? He now has a small business. So now I write off his mileage. He comes home for Thanksgiving. No, we're having a business meeting at Thanksgiving. All that mileage is a write-off. Oh, I helped him with his cell phone. Oh, that's a business write-off. He's got all of his own write-offs. So he is going to pay self-employment tax on the net. But is it cheaper that he pay tax and build credit and start a tax return, or me pay tax at my bracket and give him money? Guys, you want to family plan your taxes. That's the whole point here. If you're helping out the grandkids somehow, or you want to give the grandkids a Roth IRA, you have to plan as a family. So we sit around the table and go, okay, which tax bracket are you in? Okay, which bracket are you in? No, but anyway, so with grandkids, what we do is we 1099 the parents, and then the parents, your children, pay the grandkids. Miss Blossel, you get that? Sweet, right? So 1099 them, then they pay the grandkids, because there's no withholding, no FICA, and then you can give the grandkids a Roth IRA, and they're a partner in your next LLC. Woo! Oh my gosh. We cranking? You guys okay? Isn't this fun? Okay, now one side note before we get to the end too. Make sure you have a business card handy. Write down your name, and if you want, you're in the drawing, and you go get on my newsletter, and you can unsubscribe if you want. But every week I give out tips and strategies. It's free. Been doing it for 10 plus years. Your name, email, and phone number, and first name, last name, if you don't mind. And then I'll come by in our last 2 minutes, and we'll do a drawing for these 3 books. Welcome to the class. Glad to have you. Okay. Was there another hand over here? No? Oh, yes, you did.
So we decide.
I love this. So she said, my daughter said, we can't get that $12,000 1099 because it's screwing up our FAFSA form. I have 2 comments. Great, don't take the 12 grand. Give it back. So this is classic because kids want help. I'm just, it's like, freaking, when are we going to teach our kids financial and fiscal responsibility? We're going to give them all this money. We're paying at our tax bracket. If you want the money, you're going to eat a 1099. Learn how to pay the freaking bill. And it's funny. My 21-year-old last year was like, this is after growing up with Mark Kohler, coming to my workshop, selling books. Finally, after she got a 1099 and she owed taxes, she goes, Dad, can you explain these taxes to me? Why am I paying this? Because it finally hurt. It finally hit home. We've got to teach our kids and our grandkids, even if they're 35 years old or 3 years old, what a dollar is worth and what it means to live in America and have a small business and pay our fair share. And the kids don't get it. Financial literacy is a joke in high school and college. We have an opportunity with a business. It's an incubator to teach our kids and our family about business. It's so exciting. Second thing, if kids are filling out a FAFSA, that means they're getting student loans. If they're getting student loans, I want to have another conversation. Student loans are in a crisis in America. Over $1 trillion in student loan debt. Do you know in Wall Street Journal 3 months ago, they listed, because it's a federally reported item, how many student loans there are? There's now over 11 people. This is crazy. It was in the Wall Street Journal. 11 people that have over $1 million in student loans. The average student debt of a kid coming out of a four-year university now is over $80,000. If it's a master's, it's over $130,000. Do you know I have a client that's a plastic surgeon in Orange County. He's been a surgeon for 20 years. He's still paying off his student debt. He goes, Mark, I pack a lunch most days because I'm scared to death that if I get hurt, I can't pay my bills next month. He's a plastic surgeon making $500,000 a year. Student debts are scary. They're a crisis. If you can do anything to keep your kids out of student debt, I don't care. They don't need to go to UCLA. They don't need to go to USC. Oh, I want to go to this big school. You better freaking get a damn scholarship because I ain't paying for it, and you're not better not get a student loan. Sorry, don't get me started. Oh. Anyway, so just a thought or two on FAFSA. I'm not a fan. Yes?
Mark, the number one thing we need to do is teach our children and grandchildren to have a business.
Yes! I love it. Did you hear him? He said the number one thing we need to do is teach our kids to have a small business. And if I could get Sydney to come in, I would have her come in here, and I'm not kidding. I'd ask her, what is your requirement to graduate from college? See, I bought her a cool Jeep. It's a sweet Jeep Wrangler, 3-inch lift, big old tires. Guess who's holding the pink slip on that baby? When you graduate from college, you get your Jeep. But you also have to have a small business. When you graduate from college, I don't care what your GPA is, but you better have a small business that makes money, and you've got to get your graduation. Then you get your Jeep. And we have what's called the Kohler Independence Plan, where every year she gets a little more independent. We can't just throw these kids out the door and hope they're going to figure it out either. We got to transition them. We got to teach them about small business. I've got a workbook called 8 Steps to Start a Small Business. All my kids have their own copy, and they're working through it. It's awesome. Get it on Amazon. It's excellent. Give it to all your kids for as a Christmas gift. 8 Steps to Start a Small Business. Anyway, we can get on this topic for a while. Anyway, I get on my high horse too. Forgive me. Okay, number 5 strategy. You're going to love this. Once you're making money, you're going to say, Mark, I want to save more taxes. I paid my kids. I did my salary dividend split. I've got my S Corp here. So let's erase this here. Let's get this pretty. I'm going to build a master plan here. You're going to love this. I'm going to try to make this good. We're going to divide your life in half. Now, this diagram may not apply to everybody. Married, single, kids, no kids, old, young. Be patient. But generally, this is going to be a very typical structure for my clients. We have your life split into 2 sides. Your trust is at the bottom. Here, if you're paying kids under age 18, you have a family management company. There's another reason I'll explain in a moment. You've got an LLC that you may have converted to an S Corp. All of you that think you're going to make 30 grand or more this year, set up your LLC now. Later in the year, I can backdate it to an S Corp. So I love that. Don't call me in October and go, Mark, I made my 50 grand. Well, you're an S Corp in October. If you want to be an S Corp now, I can backdate it, but you got to start with an LLC. And it's cheap and easy in Utah. Call us. We set up LLCs. Simple or with an attorney consult. That's a whole other story. Okay. You can also have one S Corp with multiple LLCs. Your S Corp might be a partner in a real estate development. It might be a partner in a hair salon. It might be a partner in a restaurant. So whenever you set up partnerships that create ordinary income, your S Corp is the owner. This is your parent operational entity. This is your ordinary income. You feeling it? This is all going to, I'm throwing highlights. This is deep. I've got so much content here, but this S Corp is owned not by you, but by your trust. You're going to take a salary out of this, and you're going to get a K-1, and then you're going to take your 199A deduction, which is 20% deduction. We're going to find the balance between the salary and the K-1. We're going to follow the Kohler payroll matrix. Oh, you got kids. We're going to 1099 our older kids that are 18 and over. And we're also going to pay our kids under age 18 with our family management company. If you have an LLC and you're just buying your rentals, which is going to be part of your strategy as a real estate professional, and you've got your rentals over here, I could pay my kids under age 18 here, and I could also 1099 my kids 18 and over. I'm going to buy rental properties, creating passive losses. Who owns my LLCs? My trust. What else does my trust own? My life insurance. and my home, my personal residence. I'm bringing together your picture. This is what I do in a consult. You may go, Mark, oh my gosh, I'm going to pay you several $100s an hour to do this. Yes, once a year. This is your teeth cleaning. This is your physical. Once a year, you meet with your tax and legal advisor and you put your year together. What are my action items? Where am I jacked up? I want to save you 20 times whatever you pay me in an hour to put together your plan for the year. You got moving parts. Does your accountant know what's going on? What's your plan? Well, I'm going to figure it out on TurboTax. Okay, good luck. Good luck with that. I hope it works out well. Okay, so we want to bring it together. You want an advisor that understands your picture. Then you say, well, Mark, I want more write-offs. Okay, let's say you're netting 200 grand. If we went back to the matrix, that might be a salary of 60, and you're going to take a net of 140. You're going to get a tax write-off of $28,000 under the new Trump deal. Then we're down here to, oh my gosh, 112. Then with this 140 grand, you'll say, Mark, I want some more write-offs. Well, are we going to deploy it and buy some rental property? I hope so. Or we can take our W-2 and fund our own solo 401k. With a solo 401k, you may say, well, Mark, I don't want to buy stocks, bonds, and mutual funds. This is ridiculous. I don't trust Wall Street. I don't trust Wall Street either. But we're going to set up a solo 401k that can buy Bitcoin. It can buy racehorses. It can buy Super Bowl tickets. It can create an LLC and do fix and flips and rentals and real estate. It can do hard money loans. It can do financing. Your solo 401k is controlled by you, the trustee. We got that service at our law firm too, to get your 401k going. Now, in this example, if your salary's 60, this year, you can do a $19,000 deduction. So that's $41,000 W-2. We just carved out $19,000 of tax deduction. You can carve out 19 grand and go drop it into your 401k. This is where it gets good. Hang with me. Well, you're a hard worker. What should the company do for you? You just put 19 grand in your 401k. What should the company do? Starts with an M. Should do a match. And you don't have any other employees, so you can discriminate all you want. You can do 25% of salary or 100% match, whichever is greater. Well, look at this, 25% of 40 grand, that's 10,000. I can drop another 10 grand, 25% of the 60, so that's 15. I can drop 15 grand in here. Holy crap, I just got a tax write-off for $34,000. A little better than an IRA, right? This is how the rich get richer. This is why small business owners can do better than the average American. I can only do 6 grand in an IRA. I could do 19 grand in a Roth, which is 3 times what an average American can do, and I can match it for 15. So now I've got 34 grand in my 401k to go do real estate. I got a tax write-off to go do more real estate. Oh, but Mark, that's not enough. I need more. Oh, okay. You married? Anybody married out there? So with my spouse, what would be the perfect amount to pay Jennifer? What do you think? Should I pay her 60 grand? 5 grand? What do you think would be the sweet spot in this? I don't care about Social Security. We've been married 10 years. She gets the same Social Security as me. I am not putting on her payroll for Social Security. She literally gets the spousal benefit. Whatever I would get in Social Security, if I die, she gets it. If we get divorced, she gets it. So I don't need to put her on payroll for that. Why would I put her on payroll? Why would I put Jennifer on payroll? Anybody, come on. Someone knows. Yell it out.
Tax deductions, contributions.
No, it's because she'd love me more if I did that. No. 401k. So I can, in a solo 401k, your spouse can be in it. It's not just solo the owner. It includes your spouse. So I could pay Jen 20 grand. Exactly what she can put in her 401k. I'll just do 19. Well, you actually have to gross it up by 15% for the FICA. So it'd be like 21 grand. So I could put her on payroll for 21 grand. She would put all of it in the 401k, which would be 19. That's a 0 W-2. So she gets a 0 W-2, but we drop 19 grand into the solo 401k. Am I forgetting anything? One second. I can match. I got to match her because I matched myself. So 25% of 20 grand is another 5. So I can drop another 5 in there. That's 24. If we're 50 or over, I can add another 12 grand to this. So now I've got $58,000 sitting in a 401k. I got a tax write-off to do it, and that 58 can be a deposit on my next LLC to buy another rental property or a flip, and all the profit goes to my 401k tax-free. Done. So I'm self-directing my 401k and getting a tax write-off to do it, funded by my 401k, driven by my salary level with the 199A. See how these moving parts work together? And it doesn't take much to understand it. And when you ask your accountant, hey, what are we doing for payroll for me or my spouse to maximize my 199A and limit my FICA? And your accountant goes, what are you talking about? You're fired. They should know this. You should be sitting on a whiteboard once a year designing your payroll. Because you want to figure out, where am I going to put my money? Am I going to buy a rental? Am I going to put my kids on payroll? Am I going to fund a 401k? What's my pass-through going to be? What's my minimal salary I've got to take? Oh my gosh, should I push that fix or flip or my commission to next year? Oh, I don't know what to do. Yes? You're so kind. I'll give you that $5 later. Thanks for asking. So he said, well, Mark, is the 401k my only option? No. I've built this little pyramid to kind of talk about different options that you can do. If some of you are like, Mark, these numbers are not my world, that's cool. Can you do 50 a month? Can you do 100 a month? Could you do 500 a month? Let's start out with a traditional IRA. Let's start saving, because we as Americans suck at saving. So let's get into a habit of saving. We tithe, we save, we live, we save. We try to push to the next, so we have some sort of savings account that we can rely on in the future. Traditional, Roth, I could do a SEP. I literally have a video called, I screwed up and did a SEP, what do I do now? But you could do a SEP initially, then transition to a 401k. I could do a Roth 401k or a pension. Under a pension, I have clients, you can do up to $230,000 in a pension. Okay, let me repeat that. The rich can get a write-off of up to $230,000 to fund their retirement account. You can do it. It's crazy. I had a broker in Heber City. This was about 10 years ago. He and his partner had a huge year. In 2005 and 6, if you could walk and chew gum, were you not making money as a realtor in this state? He was killing it. He was down in Heber. He made a ton of money in a couple deals. They said, let's fund our pension plans. Together, they put about 200 grand each, got a tax write-off to do it, dropped 400 grand combined into a pension with an LLC, and they bought a development property out there in Heber. How do you think that worked out, right? Awesome. So they got this development done before the 2008 crash, and they tripled their money. They put $1.2 million into their pension plan, tax-free. The IRS said, well, you've exceeded your plan contributions for your life, so you can't put any more money in this pension, but you're done. It's growing, and you can take a salary out, and you can retire and pull your money. There are so many options. So as you start making more money, you want to ask your advisor, hey, what can I do besides an IRA? What can I do besides 401k? How much money am I making? What about my HSA? What about my HRA? We're not even into healthcare yet. He said, what does this change when you're 70 and a half? No, you can still contribute to the 401k after 70. What happens at 70 and a half is you have RMDs. Hey, sir, that's walking out. What are you guys? Can you tell Matt Sorensen to come in here real quick? He's at my table. I appreciate it. Can you tell him? Say, Matt Sorensen, come in here. Thank you. Okay. You can still contribute to a Roth. You can still contribute to a 401k and a regular IRA even after age 70. The issue is the IRS doesn't want you to die with a bunch of money in your retirement account, so they make you to start taking RMDs. Those are your required minimum distributions. So at every year, in December, we're busy because clients are calling up going, here's how much money I've got in my IRAs and everything. What's the minimum amount I have to take out? And so we will literally deed them a piece of real estate or some cash to meet the distribution. Here's a quick, cool strategy. I have clients that buy rental properties in their Roth IRAs. They may even get a Roth with a loan, and they're slowly buying that rental property. And then at age 50, 59 and a half, they can literally deed the rental property to themselves, tax-free, and live in it. So the Roth can own that rental property up to 59 and a half, and then you can just deed it out. Now, we've got the man, the myth, the legend, Matt Sorensen. Sorry, I had to call you in. I got stumped on a question. This is Matt Sorensen, my law partner, who taught the class on IRAs.
Thank you for adding law partner before that.
Yeah, yeah. Whenever we're on the radio show and go, this is my partner, Matt Sorensen, we get some questions. So I try to say law partner. Okay, now.
A handheld, maybe?
No, here, I'll give you this. Okay, so here's the question. So anyway, sorry, I didn't mean to be rude to anybody that has partners. I'm just saying we're trying to be clear on that. Okay, now, even though we stand here close. Okay, so, or you can just hold it like this, is what we were doing earlier. You can do this, there, you're good to go. Okay, so here's the question. With a 401k, do you have to take RMDs at 70 and a half?
If you own the business, yes. If you're not an owner in the business and you're still working, you can avoid RMD. But if you own the business, there's an exception that says when you reach 70 and a half, you don't have to take RMD if you're still working. Unless you own the business, then you have to.
Okay, and can I contribute to my 401k even after age 70?
70 and a half, can you contribute? If you're still working, the same rule applies as the RMD.
Still working, and I own the business.
Still
too.
working, but if you own the business, no.
Oh,
Once you're 70 and a half, you own the business, you have to start taking RMD, you can no longer contribute
to a 401k.
to a
You-
401k.
What happens if your spouse owns it?
Also, I think you're screwed.
Okay.
Yeah, that's a technical term. That means you can't do it. I'm pretty sure you have the same problem because pensions have RMD also. Eventually, you got to start drawing it out at 70 and a half.
Yeah.
You can still put into a Roth IRA.
The answer to everything.
Yes.
Okay. All right. Well,
Okay.
thank you.
Can I be excused?
You can be excused. Thank you, Matt Sorensen. We love you. Okay, he's got the best-selling book. Hold up your book. This is the Self-Directed IRA Handbook, the second edition, the best book in the country, best-selling book on IRAs. And
I don't want to take these home. But
go visit. One other thought, guys, I want to just say this real quick, and we've only got 20 minutes left, and I had a couple more points. In this little master diagram, one thing that I talk about in my Business Owner's Guide to Financial Freedom, let me get deep for a minute. One of the problems with a lot of small business owners, and I consult with, if I just do 3 consults a day, I'm going to meet with 1,000 business owners a year. That's 300 business days a year, times 3, it's around 900. I learn things from you, oftentimes more than you may learn from me. I hope not, you're paying me. But I literally see patterns. I see patterns of success and patterns of failure, where clients just get screwed up, and I'm like, no! And then I see other clients, oh my gosh, this is the best idea ever. So I wrote a book about the Business Owner's Guide, because Wall Street isn't telling you this. They don't care. Wall Street is about employees and big Fortune 500 companies. They are not about the small business owner. It's Wall Street versus Main Street. In our tax legislation just last year, there was a whole carve-out for individuals, a whole carve-out for small business, and a carve-out for big corporations. That's how it works. Well, no one's in here saying, well, my financial advisor at Merrill Lynch said I should just buy more of this, of their crap, right? Okay, so what do small business owners think of as their number one retirement? What do you think? What do small business owners consider? Surveys that have been out there. Their business. Business owners see their business as their number one retirement. So they get into a fallacy. Where do they put all their profit? Back into what? Mark, my business is my best bet. I'm going to take all my profit and drive it back into my business. Well, maybe it's not their best bet. What happens if there's a problem in their business? Maybe the market shifts. Maybe their market changes. Do you think business owners are often realistic about what their business is really worth? Is it sometimes an emotional issue? My business is worth this and my kids should pay me for it? My farm is worth this and my kids are lucky to get it? Sorry, Dad, we don't want the farm. We don't want the business. We see what it did to you. We don't want it. And all of a sudden they're stuck with this business they think's worth more than it really is. Can you see all these paradoxes that go on in a small business owner's mind? So with Randy Lubke, we wrote this book to say, okay, in this landscape, what should I be doing as a business owner? And all I encourage you to do is take a little profit. I want you to drive money back in your business if it's working. That's cool. But take some out every year to fund some other options. Why are we not buying more real estate? And we're all here. We're here at the summit because we know the value of good real estate. Cash flow and appreciation. We get it. Tax write-offs. I didn't even get into that. But we can take some of our profit and deploy it into real estate so that when I turn 59 and a half, 60, 70 years old, 40, 50, I can have cash flow from my real estate. I can have cash flow from retirement accounts that are completely asset protected from a lawsuit. There's only 2 people that can touch your 401k. The the IRS and your ex-husband or ex-wife. That's it. In a divorce or an IRS audit. No one can touch it. O.J. Simpson is still living on his 401k. He's a whole chapter in my book, Be Like O.J. And I like it because we're on second edition now. He's on parole. It's like so exciting. Okay, anyway, you can live like O.J. So now if your business gets into a huge lawsuit, it's gone. But no one can touch your 401k. So peel some money out. Invest in what you know best. Anyway, just get going on that. Thank you. I appreciate that. Hopefully that hit a chord with a few people. Appreciate it. Okay. Now, I get into real estate because I want to just hit a couple last points. Everybody in this room, I would presume, is doing some sort of real estate in their life. As such, the IRS is going to define you as one of 3 types of investors. And on your tax return, you can check the wrong box very quickly. You could be a passive investor. If I buy real estate and I'm a passive investor, where do all my write-offs go? Do I get to write them off against my other income? No. They stay stuck over here. They're a passive loss, and they go into a bucket. They go into a passive loss carry forward bucket. And I love this bucket. A lot of people go, yeah, Mark, my accountant said I make too much money and I don't get a write-off for all my rentals, so I don't write off my travel to check on my rentals. I'm like, oh, no. I want to write off the kids and the travel because all those losses go into a bucket, and someday you can pour them out. Anytime you sell a property, I can pour out your bucket on any property, even if your day job is being a pharmacist. So even if you're just a passive investor, we want to build up this bucket of losses and carry them forward. Now, an active investor gets to take a write-off of up to $25,000. So if we generate any losses here, any losses in my rental real estate, I can deduct it against my W-2. But if I make too much money, if I make more than 150 grand AGI, I lose the write-offs. Or do I? Do I lose them? Where do they go? Into my bucket. So every client of mine is at least category 2 active. I'm active. All you have to do is be a decision maker. You don't have to be a realtor, a contractor, hours requirement, doesn't matter. Every one of you should be active, and your accountant should be checking that box. I see tax returns all the time. Rental losses for up to $12,000, $25,000, and their income's around 100 grand, and they're going in the bucket. They forgot to check the box. So you've got to say, where are my rental losses going? How much money did I make? Third, if I'm a real estate professional, option 3, how much of these losses from rental real estate, which all of you in this conference are looking at, these rental losses, how much of them are deductible against my other income? All of them. This is huge. This is why realtors and contractors and real estate flippers, real estate wholesalers, investors, we love rentals because you get to deduct all these losses. You don't have a bucket. I have a bucket because I'm a tax lawyer. But you as real estate professionals should be taking these losses and writing them off against all your other income. Now here's the beauty. You say, well, Mark, I got a day job. I still buy real estate and I have rental losses, but they go in the bucket because I don't do 750 hours and it's not my primary job. I have a different job. You got to meet both tests. Well, here's the beauty. If your spouse qualifies, you both qualify. This is big. Okay, now I see this beautiful couple up front. I'm just going to pick on you. So, or both. One of you have a day job? One has the day job?
Financial advisor, real estate broker.
He's a financial advisor, W-2, and she's the real estate broker. Oh my gosh, you don't even know her street value. This is huge. Oh, sorry, that didn't come out right. This is huge. Do you know the tax deductions on their tax return? Oh, it's just like a match made in heaven. If he was a single guy, W-2 financial advisor, he'd be screwed. No write-offs. Now he marries her. She's so pretty. And this is why I'm setting up a website called taxmatch.com. And you might enjoy long walks on a beach. I have a K1, and I'm a real estate agent. Oh, bing, 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 bing. Normally I would say you want to look for someone really boring with a W-2 benefits, maybe a financial advisor, a pharmacist, a dentist, someone just day job. No goals or aspirations. Just keep it steady. And then, but the beauty is, isn't it funny? I see it all the time. I see a couple, they both have these stale W-2 jobs with a glass ceiling, and they're frustrated. They're trying to build wealth. They can't break through. They're just stuck. They're trying to get through that mentality. And I say, hey, it's not an all or nothing. One of you can provide the stability, and the other one can start to experiment with the entrepreneurship and the real estate. It's don't quit your job yet, just get started. I have a whole article on Google. If you type, don't quit your day job, Mark Kohler's video article comes up. Because so many people call me, Mark, I quit my job, I'm an entrepreneur now. I'm like, no, we don't quit our job until the business can support you. Let's make sure we're out there testing the waters and getting the real estate going. And so the beauty is, if you can build this synergy and have one of your partner, your spouse, whatever, building that real estate and the entrepreneurship that gives you no glass ceiling and you can break through and build retirement and options, and the other one's got that stableness that we need. Because as entrepreneurs, we know our income's going to be up, down, up, down. If you were living on her, you'd be going crazy, right? But see, you have the best of both worlds. When I have two entrepreneurs that are married, oh my gosh, buckle up. We're making money, we're losing money, we're making money. This is why when I got married, my wife, she was kind of excited. She was attracted to me, not only for my looks, but because I had all these dreams. I had all these dreams. She grew up with two W-2 blue-collar workers. Her parents are wonderful, but they're just like worker bees. And every year they get their 1 week of vacation. They get in the truckster and go and then come back. And every week, had a paycheck. It was weak, stable. She meets me in college and it's like, I got dreams, I'm going to do this, I'm going to do that, and she's like, well, that looks kind of cool, and he's kind of good looking, I'm going to go with that. So about 5 years into our marriage of making money and losing money and a little bit of marriage counseling, I found out that my counselor said, women do want some stability too, that we need to have stableness, we need to create some stableness so that we have security, and I was like, oh, okay. And so that lifestyle of stability was kind of a shock. And now we've had some really highs and we're doing okay. But man, building a business is hard. And so you want to, I give like little classes. I do give classes on, building a business and a relationship because it can be really challenging. You're communicating and all that. But from a tax standpoint, it's really exciting when you have that real estate and day job combination. It's really exciting. So anyway, real estate professionals, all of you should be thinking, any thoughts or questions on that? I got one last strategy and then we'll call it a day. I've got 10 minutes left. Whew. Any thoughts or comments? Okay. Now, no, I could. Well, here's the thing. It's a 2-part test. So here's the deal. I'm just going to use hers. What's your first name? Carrie. Okay, Carrie's got to meet 2 tests. First, her primary job is real estate. Done. She's a broker. She has to do 750 hours a year being a realtor broker. That's 13 hours a week. If she's a realtor doing anything, she's done by Monday night, right? Done. So she's got her 750 hours. Now, if she buys real estate, rental property, can she have property managers? Can she buy a bunch of rentals in Tennessee and still get the write-off? Yes. There's 7 tests that allow you to qualify as a material participant. And so we got to find out which one you are. I once had a realtor broker, had 30 rental properties, and the IRS argued that he couldn't take the passive loss deduction. I literally had to go down to the IRS building and meet face-to-face with the agent and fight through it. And I laid out the 7 tests, and I go, we qualify under 2, 5, and 7. He's like, all right, you're done. But they don't want to, if you don't know it, you can get screwed on this. So anyway, but there's ways to qualify. You're good. Okay. Last strategy. I just want to bring this up because it's so powerful too. Healthcare is such a burden. Healthcare expenses are, again, continuing to climb. Health insurance, whose health insurance didn't go up premiums this year, right? It's terrible. And so I have a plan called Kohler Care. It's not Obamacare, it's called Kohler Care. And I have 9 ways to help with your health care. Now, the beauty of this is, item 2 no longer applies. The health insurance penalty is gone. So you don't have to do the health insurance penalty. But I want you to choose the right type of health insurance, deduct your health insurance. All of your health insurance premiums should be paid out of your S-Corp. There's so much. I've got a chapter in my book on this and more. But the one thing I want to highlight just on this list for everybody here in our last few minutes is the health savings account. A lot of people forget how powerful these are or don't even know. An HSA, I'll just summarize it this way, is like a Roth IRA on steroids for healthcare. That's what it is. Just let me repeat that. An HSA is like a Roth IRA on steroids for healthcare. The reason why is you get a tax deduction to put money in your health savings account. It grows tax-free, and it comes out tax-free for any medical expense. Teeth, dental, eyes, copays, deductibles, prescription drugs, emergency room visits, massage therapy, acupuncture, all of that's covered under your health savings account. So anybody who's got an HSA here? Anybody already? Look at this, oh my gosh, half my room. Okay, now this is good. How many of you that already have an HSA, how many of you's got their debit card with them? Anybody? Can you just hold it up and show someone? That's this gentleman right here. This is a debit card for his health savings account, and he can go through and pay for his prescription. Look at that. It's like a Visa for healthcare. Do you love it? I do. This year, married or single? Single. Any other single real estate professionals out there? Okay, ladies? Okay, I see a couple of hands. Let me put your number here up on the board. Okay. I'm trying to get tax match going. You could be my first testimonial. Okay. Okay, all right. Okay. Now, single, this year, he can put $3,500. 10 minutes left? Okay. We got a little, oh, he's giving me 5 extra. Thank you, sir. Okay. He's single, he can put $3,500 in his HSA this year and get a tax write-off, no matter what his income level is, whether he owns a business or not, whether he has an S-corp or not, whether he has passive rental income or not, doesn't matter, single or not, $3,500, right on the front page of your return. Mitt Romney can take a $3,500 deduction on the front page of his return. Mitt Romney's old enough, he could probably do $4,500, get a $1,000 makeup over age 50. So now, that goes in his HSA and grows tax-free and comes out tax-free for healthcare. Now, here's where it gets good. If that wasn't good enough, you can self-direct your HSA. Let me throw this out. This is my HSA in Chicago. This little HSA of mine owns an LLC called Kohler Holdings LLC, and that rental has been in my HSA for about 8 years now. It cash flows about $225 a month. And I can pull money out of the LLC anytime I want for healthcare expenses. It's never even filed a tax return. I don't even think the IRS knows it exists. I have an HSA. I could sell that property tomorrow. The money goes back into my HSA, and I could buy another property. I could loan it to one of you doing a deal. So my HSA is out doing real estate. Look at it. It's the cutest little meth lab. I mean, it's adorable. And I have a friend, he tried to do a drive-by, not the drive-by you're thinking maybe, but a drive-by tour with some other real estate investors. He's like, oh yeah, Mark Kohler's HSA owns this one. And they turned down the street, and it was roped off for a drug bust. And he's like, not today. And so, so it's a Section 8 rental, and it's cash flow is wonderful, it's great. But anyway, that's been sitting on my, and so you may go, Mark, how did you do that in an HSA? It was seller financing, it was $45,000. It's low-income housing, that's cool. I put down $4,500 at 10% down, got a mortgage on it, seller carryback for about $39,000, and I've had it 8 years. I have a Section 8 tenant. The government sends me a rent every month. I've got a little grandma living in that, and her kids are terrorizing the neighborhood. But this is a little rental that's sitting in my HSA. I've got clients, you could buy Super Bowl tickets on it today, StubHub them 3 days later for the Super Bowl, and that profit goes into your HSA. I mean, it's crazy. Okay, good question. You would pay UBIT under an HSA for financing. Now, because the depreciation on my property and my expenses, I'm able to, really I don't have a taxable event until I sell the property. At that point, if I have debt on the property, there would be a proportional amount I would pay in UBIT tax. That's right. Now, here's another tip. If I paid it off before 1 year before the date of sale, I have to go a full year of being debt-free in the HSA, and then I can sell it with no UBIT. Now, another thought for some of you that are deep on this, Matt Sorensen was just teaching this class next door, so I'm going to get deep for a minute. So your IRA can borrow money and buy rentals. But when you sell it, the IRS says, well, we won't tax you on the profit based on the pro rata ownership of your IRA, but for the debt portion, you need to pay tax on that because you use leverage. But it does not apply in a 401k. So I have clients that bought rentals with debt in their IRA. We just transfer the IRA to the 401k and sell it on day 2. No UBIT. Now, I can't transfer an HSA to a 401k, but for those out there with an IRA, it's very doable. So it's deep. Thoughts or comments on, so that's just the HSA. You have to have a high deductible plan, and you can get an HSA. Off to the races. Because it's, okay, I don't have to file a tax return because I don't own it. The health savings account owns it. And a 990T is the required tax return for an HSA, and I only have to file it if it has taxable income. And because of depreciation on the property, whittling off the $250 a month, I break even or less, and so there's a carry forward loss inside my HSA, which is another important point. When I go to sell it, I'll be able to dump out the bucket of losses within my HSA against any gain. So I don't own this property. My HSA owns it. If it did make $1,000 a month of taxable income, I would have to file what's called a 990T. If I had debt on the property, and then I'd have to pay the UBIT tax. But let's say there was no debt on the property and it made $1,000 a month. No tax returns required. If no tax is owed, no tax returns required. So what's really cool here, guys, is this the same concept for 401ks, HSAs, and IRAs, is every time you pass go, every January, you can put more money in. Like this example, I could put my 34 grand in every year. Ding, ding. But then I can invest it and get unlimited returns. So I could turn that 34 grand into 60 grand, then next year put another 34 in. Now I'm at 90. Then I could take that 90 and invest that and turn it into 180, and then next year put in another 34. Now I'm at 210. This is, if you've watched the Dave Ramsey, this is your homework. Who has watched the Dave Ramsey Power of Compound Interest on YouTube? Dave Ramsey, Power of Compound Interest. Raise your hand if you've watched it. Not even 2 hands. Guys, put it on your to-do list. Go to YouTube. It's a 4-minute video. YouTube, The Power of Compound Interest, Ramsey. Make your kids watch it. Make your spouse, your partner, your best friend watch it with you. It'll blow your mind. He only assumes a 12% rate of return, and what the power of compound interest will do inside an IRA or 401k, it's exponential. I just got chills saying it. And then you do it with a self-directed plan. Oh, hallelujah. Okay, anyway, sorry, I get carried away. Okay. Any other questions? Now, on healthcare, I want to encourage you to check out more reading and study on this. HRAs is a health reimbursement arrangement. My wife and I use that too. We use it in our law firm. In my tax and legal playbook, I have a whole chapter on healthcare. If I'm sold out on books out there with Sydney, you just say, hey, I'll buy the books. It's at a deep discount. It includes the Kindle and audio. I'll mail them to you when I get back into the office on Monday. No cost for mailing. This, guys, I'm just going to say it. I didn't come here to give a big sales pitch. I'll just tell you how you can get more info if you want it. If you don't want it, I don't care. I came here as a favor to Steve Olson. So I've got a little flyer out there. My daughter has it. I've got a little 4-book combo for like $60, which includes all 4 books plus some Kindles and audio. I also have my 8 steps to start a small business workbook, which is $99 on Amazon. I throw that in with these for $140, so you save more money there. Then finally, I have my tax and legal library. For 7 years, I've been shooting videos every year on all my topics. I've got 60 videos in there with like 30 hours plus hours of content. The next 2 weeks, I'm in the studio shooting this year's updates of 20 more videos. Once you buy this little video library, you get the access to all the updates every year. As long as I'm alive, it's lifetime membership as long as I'm alive doing my practice. That's like $300, and it includes all the books too. So you get all the books plus the videos. You can start watching them immediately on Monday. I'll email you the membership and the ID. Finally, for those of you that need an LLC or a corporation, let me just say this. If you're like, Mark, I need an hour. I would love you to build me a little diagram. Tell me what my checklist is for this year. Look at my tax return. In an hour, I can knock out 99% of my clients. I look at your tax return. You tell me what entities you have, what real estate you have, married, single, kids, boom. We make a plan, a checklist, and I get your info if you need to set up an entity. So we charge $800 to set up an entity in any state, and it includes an hour of a consult with me or one of my attorneys. So you may say, well, I can do it on LegalZoom for $200 or $300. That's cool, go do it. But you don't get the hand-holding and the quality of the documents and the education. So I have this little package that gets all my education, all the books, yada, 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 an hour with one of my attorneys and an entity in any state for $9.99. So if you want it. Tax write-off. The filing fee is your only extra fee depending on the state we set up the entity. So if you need an S-Corp or LLC for this year, That's a little package. Take the flyer with you. I'll honor it. You don't have, it's no pressure. You have to buy it today or you lose it. Take this flyer. You turn it in. I'll honor it. Okay, that's the end of my sales pitch if you want it. Okay, last topic. Let me see if we have anything else. To change my mind, Roth. I don't want to go into that. Yeah. Let's just do our last 5 minutes or 4 minutes on just some general questions on anything we covered. I'm all yours. First here, and then I'll come over to you two. Yes?
Solo K contributions you could do in this year for last year, and
Yes.
then convert them this year and plan your tax strategy the following year, right?
Yes. Okay, everybody hear what he said. This is deep. If he had a 401k set up last year by December 31st, he can contribute to his 401k for last year and get a tax write-off up until September 15th. You have all year to do it, up until September 15th. Now, if some of you are like, well, Mark, I didn't have a 401k set up, darn it, then what I do is set up the SEP. I screwed up and did a SEP. So what we do is a SEP for last year, because you didn't have the 401k. As soon as we set up your 401k, you can roll it into the new 401k, do your contribution this year, and you can double down on both years and then start investing. So we have a plan to still grab last year through a SEP, but then roll it into the 401k.
You can convert that to Roth though, in that year, right?
He said, can you convert it to Roth in that year? Yes, you can convert money to a Roth inside a 401k, but you cannot convert it and then roll it into the 401k. So you want to do it once it's in the 401k. And if you're going to be doing conversions to Roth with a 401k, go talk to Matt. He'll tell you the rules on it. He's really good. He has a whole chapter on that in his new book that you can get out there on the 401k conversion strategy. Yes, ladies first.
So you said of an LLC for your rental property?
Uh-huh.
You wouldn't put it under the S corp?
No. Yes. Yeah, I would not. Okay, let me explain this. By the way, let's get crazy here. I'm going to try to spin this around without making it fall off the edge. Let's try this. Okay. It worked out. Okay. All right. Now, her question's a good one because I love to get into asset protection. I have a whole book on asset protection. We've been focused on taxes a little too much today. Over on this side, we got our S Corp and blah, 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 right? Okay, blue's not looking good. Okay, so over here, clients start buying a lot of rentals. Anybody in here own more than 2 rentals? What? Okay, so what do? I have 4 options. Option 1 is you set up one LLC, and you could have 2 or 3 rentals in it. And I could take that and say, okay, here's my LLC. I've got my rentals in it. It's tight, it's clean. I got a clean LLC. I got a board of advisors. I got my operating agreement. I'm doing my minutes every year. And if your accountant or lawyer told you, oh, an LLC is easier than a corp, you don't have to do your annual minutes, bull crap, good luck. Because when you get into a lawsuit, it's like an atheist in a foxhole. Oh, I don't need to believe in God. As soon as they're out in the war and they're in the foxhole, they're praying. And so as soon as you get into a lawsuit, you'll be doing your annual minutes for your LLC. Trust me. Been there, done that. So make sure you're maintaining your LLC property. We have a company maintenance program that's very affordable at our firm. Get your LLC clean, tight. You got your 3 or 4 rentals. Maybe 200 or 300 grand of equity. I don't know, a couple $100 grand. Oh, but Mark, I've got a lot more equity in that. Ooh, okay, so let's maybe set up 2 or 3 LLCs. Maybe this is my Arizona LLC, this is my Utah LLC, and this is my Texas LLC. So I can put my Texas properties in this LLC here. I can put my meth lab rentals in this one, and I can just kind of spread them out. And you might spread them out based on type of property, type of risk, and these are going to be different LLCs by state. It could depend, but don't get sucked into the Nevada, Wyoming crap that you're going to set up an entity in Wyoming and have it, that comes down to option 4. But you're going to keep it simple, keep it affordable. What was your question again, too?
Just why did you put that in the trust and not out of the?
Oh, okay. Now, and on that note, we are doing these on the LLC side because we have no transfer tax. We have carryover basis. I can sell a property. I can do a CRT. I can do a 1031. I can bring on partners. Once you put any of these LLCs in an S Corp, you're jacked up. S Corps are not built for owning rentals. S Corps are built for flipping property and commissions and income and sales and services. They are not built for holding. You never, never, never want your rentals in an S Corp. If they're in there, when you sell it, we'll take the money and run, but we're not going to put them back in there. We want to get them out. So S Corps do not own rentals. The trust owns these LLCs because if you die, I want your trustee to take over and maintain them, sell them, get them ready, and then dish out profit to your kids or whoever you're going to give money to, brother, sister, husband, whatever, right? Okay. Third option, series LLCs. We love the series LLCs in the state where you can have a series LLC. Now, luckily, Steve's doing a lot of work in Texas and Utah. It's a great fit. You can have a series LLC in Texas and Utah. But there's only 14 states now that have series LLCs. This is a table in the back of my book. If you're not in a series state, you can't have a series LLC. It doesn't work. So here's our series LLCs right now. Delaware, Washington, D.C., Illinois, Iowa, Kansas, Minnesota, Missouri, Montana, Nevada, North Dakota, Oklahoma, Tennessee, Texas, Utah, Wisconsin. So if you're buying rentals in those states, we use the series LLC and we have baby subs. And the beauty is you still have one tax return, one setup. You can have as many subs as you want. You can set them up on your own. We give you a series LLC and the document to create as many subs as you want. So you don't have to call us every time. The only state that's charging for a sub-series filing is Illinois. It's $50. But you can set up as many subs as you want in Texas and Tennessee and Utah. Those are great. But if I've got rentals in Arizona, Idaho, or California, they're going to be over here, not in your parent LLC sub-series. Your fourth option, and this is where I have clients that have $1 million worth of real estate or more. You're really cranking. Maybe 10 properties or more. We set up a COPE charging holding company LLC out of Wyoming, maybe Utah. Since you guys are here in Utah, I like Wyoming because if you're trying to do privacy, I've got to give you a tip here. If you're trying to do privacy planning where you don't want your name on public record, Wyoming is where I can hide you. Utah is not. I have to disclose who the managers are, and you have to have a registered agent and a street address here in Utah. We do mail forwarding and privacy strategies. Wyoming would be the best fit for that if you're interested in it. But we have a parent LLC that provides COPE charging order protection, and then this LLC owns all your other LLCs, even if it's a series LLC with baby subs. This gives you 2 layers of asset protection for the textures and drivers and your teenage drivers and potential lawsuits inside, outside. This is the maximum protection. Now, there's fly-by-night companies out there that sell this to everybody, even on their first rental. And I could name these company names, especially in Utah. If you've been sold this package and you have one rental property, you were ripped off. We build up to this. You can start here, go here, go here, go here. We graduate you up to it. We want you to feel comfortable working with a firm like ours where 3 years from now, we didn't mislead you from the beginning because you'll feel it, you'll know it. Anyway, this is a more advanced strategy, but it's all owned by your trust. Now, on this tip of privacy, in my book, I have a whole book chapter on privacy strategies. The father of privacy protection, come on up, Steve, get me off stage, is J.J. Luna, who wrote the book, How to Disappear. He's coming on my radio show this coming Wednesday. I am so stoked. It was the most listened to podcast in the history of my 10-year podcast when he came on last time. So he's going to be on this Wednesday. If you want to listen to my podcast, go to iTunes, Refresh Your Wealth on iTunes. And J.J. Luna, and we got a frantic hand back here. I know there was a hand. Yes? Okay, we got to start. Watch out for shelf corporations. Don't do it. Thanks, everybody, for having me. I love you. And Steve, thanks. Oh, I was going to do my drawing.